Hello, my name is George Mitten and I'm the investment writer here at Nutmeg. I've asked James and Brad from the investment team to sit down and discuss their views on the market. Let's see what they've got to say. So, is there going to be a recession?
Well, look, undoubtedly the ongoing debate between the US and China on trade has really shocked and disrupted the global industrial production cycle. And economies with greater exposure to industrial production have been rocked as well. So Germany, Japan, South Korea. But of late, the narrative has extended from that towards the US because of the shape of the yield curve becoming very flat and inverted. I think that is a bridge too far. That, for me, is bordering on recession hysteria.
Thank you, Brad. Okay, you've talked about the recession elsewhere in the world, but what about in the UK? Do we have any concerns about a local recession here, James?
Yeah, that's right. So UK GDP data was out last week, and what it showed for the second quarter was a small contraction. Now, the manufacturing sector really is struggling from the uncertainties over Brexit, and the manufacturing sector had to ramp up its inventories ahead of the original April deadline, and then has, of course, had to get rid of those inventories throughout the second quarter. The services sector, however, is really where the surprise was, and there's been very little growth in the services sector in the second quarter. It was slightly positive, but really stagnating, and really that's a story of an economy that's struggling with the uncertainties of the ongoing Brexit negotiations.
And that also chimes with the global theme that I mentioned earlier, because the UK, unlike Japan and Germany, is they service the global trade flow, the global trade cycle differently. They service it through commodity underpinnings and insurance and transactional support to global trade. So that's why it makes sense that our services sector are suffering.
Yeah, so not probably what the new Conservative government would have wanted to hear in its first couple of months in office. But 2 quarters is what's required for a recession of negative growth. We've only had one so far. Clearly, there's an opportunity for revisions in economic data. There's also the opportunity for a lot to change between now and September, October with Brexit.
We've heard a lot about the yield curve and the inversion of the yield curve. Brad, can you tell us more about that?
Yeah, that just means that long-term bond yields or long-term interest rates are lower than short-term interest rates. And historically, that has been one indicator of recession. But what we need to understand about that is that there are many reasons why long-term bond yields could be low. And in the past, for this to be a reliable recession indicator, we would need very high short-term interest rates as well. And we don't have that right now. So by reference to short-term rates, whether nominal or real, we can't really say that policy is tight. And that's what has been required in the past to tip an economy into recession.
Brexit. James, what's the latest?
We remain of the view that an election is most likely, or the most likely next outcome. We think that the Parliament is going to return from its summer recess. We expect them to launch a vote of no confidence in the current government. That's on the basis of the Conservative Party's sort of stronger, harder line with the EU so far. Now that vote could be successful, it could not be. It's worth reiterating that the parliamentary math is very, very tight, and there are still a range of potential outcomes for Brexit. But on the balance of probabilities, we think that in the near term, it's highly likely we will have an election. I would say at this point, interestingly, an election doesn't take no deal off the table, and that's really important for investment markets, for asset markets, because the fear of no deal has been driving some asset prices of late, or a higher probability of no deal, we should say. And that's why you've seen a decline in the sterling, unfortunately, just before the holiday season for most UK residents. But also we've seen a flight to safety to government bonds on the back of the trend that Brad was talking about, and also away from those sort of assets that will potentially perform poorly in an election environment or in a no-deal environment. And a good example of those is FTSE 250 companies, the medium-sized UK equities. Back in July, we made some changes to our investment portfolios at Nutmeg. We bought more UK government bonds to take a more cautious position, and we also sold out of the majority of our holdings in FTSE 250 stocks for this very reason.
I think it's fair to say that on a daily basis we're looking at the way these things develop, and we always stand for our fully managed portfolios to change those allocations around as we see fit.
Thanks both. Thanks for giving up your time. We appreciate it.